In this video, we are going to talk about the how to tell when the stock market is overvalued. So before starting this video, please like this video, and subscribe to this channel for our future updates. One question investors often ask themselves is, how do you tell whether the stock market is overvalued? Are prices too high? Should we wait for the market to go down, or is now actually a good time to get in? And it is an important question to ask because, let's be honest, no one likes putting their money in the stock market and then seeing prices go down. Fortunately, there are a number of indicators that we can look at in order to determine if the market is overvalued, or at the very least to get a good feel for where market valuations stand. There are 4 key indicators that we can use to determine whether a market is overvalued, fairly valued, or underpriced. I'm gonna use the current US market as an example, but you can use any market at any time with these indicators, and some of them could also be used for individual stocks. Before we have a tendency to begin, why don't you hit the subscribe button and the bell notification icon so that you never miss any of our videos? Let's begin. The PE ratio. If you know anything about investing, you've probably, hopefully, already heard of this metric before. It is the PE ratio, or the price-to-earnings ratio, and you can get it for individual stocks, sectors, or even whole markets, and you can use it to get a feel for if things are overvalued. So to calculate it, what we do is get the price of the index, basically the overall value of the stocks that compose the index, take that cost, and then you compare it to the total earnings of those stocks, basically how much money are the stocks bringing in terms of profits. This cost versus profit is quite the oldest benchmark figure in the book, and this PE is really simple to find. All you need to do is do a good old Google search and go on a website like Yahoo Finance, or multiple.com and find this graph. Now, as you can see, the current S&P 500 PE ratio is roughly 37.3, so if you take that and look throughout history, you can see that it's quite a bit higher than normal figures. The average ratio throughout history is 15.85, and right now stocks are trading at more than double that, which isn't that good of a sign. The current PE is similar to what it was back in 1999, when the dot-com crash was about to happen. This means the current market may be overvalued, but we have to look at the other indicators in order to confirm this hypothesis. But there's also been several famous investors who have criticized the traditional PE ratio for measuring the markets, as they say earnings in a particular year can fluctuate because of business cycles, thus making it not really accurate, especially in years such as 2020. That's where Professor Robert Shiller came along and developed something called the Shiller PE Ratio. The Shiller PE Ratio. What Professor Shiller did was he averaged the earnings over the past 10 years and he adjusted them for inflation, so that short-term market fluctuations would not be in the equation, therefore making it a more accurate way of measuring the market, according to many at least. If we look up what this value currently stands, the current Shiller PE ratio is at 33.7. That's a lot higher than what it normally is. If you look back through history, the average Shiller PE ratio in the past 150 years is 16.75, making the current value about twice the average. But there's more to the story. There is one more indicator we need to look at to confidently tell whether the market is overvalued or not. Close but no cigar, stock market targets record highs amidst stalled COVID relief. Data-driven expert chat program. A collaborative marketplace where people can chat with experts who can solve their problems. The Buffett Indicator. Warren Buffett is probably known as the greatest investor of all time. He's also known as someone who doesn't like to time the market, and he usually just focuses on buying good quality companies on sale. However, he does use one formula to see how the market is looking. He once said in a Fortune magazine interview that it is probably the best single measure of where valuations stand at any given moment. What the so-called Buffett indicator measures is the market cap of corporate equities divided by the nation's GDP, essentially the total prices of stocks compared to how much they are producing in terms of goods. As you can see, at the current point in time, this indicator sets at 183.9%. It's higher than what it was in the 2008 housing bubble crash, and it's even higher than what it was in the dot-com market crash. In that same old interview, Buffett said the following: "The indicator spiking before the dot-com crash should have been a very strong warning signal, and perhaps it should be the same thing today, who knows." What the index is ultimately saying is corporate equities are trading at very high prices. When compared to how much the respective companies are producing in GDP, there is a big gap between prices of stocks and the overall economy. The earnings yield. There is one final way of determining whether the market is overvalued or not, and it relies on the fact that, at the end of the day, when something is overvalued, it's all relative, and you need to compare it to what you could otherwise do with those same money. So, what you should always be doing is relating the returns that you can get in the stock market to the returns that you can get in other asset classes. The very first thing that we need to determine is what the return that we can expect from the current market levels. A gross indicator is the earnings yield, the 12-month earnings divided by the share price. Basically, it means taking the market PE seen earlier and calculating the inverse of it. Take the earnings, divide it by stock or index price, and you'll see the percent return you could ideally get for that single stock. If you divide $1 of profit per share by the $33 share price, the earning yield you can expect is 3.0%. The one thing missing in the equation is the growth of these earnings, which will vary deeply as time goes on, but this particular measure is focused more on the short term. Investment managers often compare the earnings yield of a broad market index such as the S&P 500 to prevailing market interest rates, such as the 10-year U.S. Treasury yield. If the earnings yield is less than the rate of the 10-year Treasury, stocks may be considered overvalued. On the other hand, if the earnings yield is higher, stocks may be considered undervalued. Of course, the comparison is not meant to be done in a literal numeral way, but rather in a relative way, as equities always demand an extra risk premium of a few percentage points over risk-free rates such as those of Treasury bills. So, if my stock market return is at 2.67%, what about other asset classes? The main asset that investors compare things to be savings accounts and bonds. As far as bonds go, the 10-year Treasury bond right now is yielding 0.90%, a very low return no matter how you look at it. And it's not really any different with banks these days, as savings interests are stuck at around 1% or less, which makes the earnings yield of 2.67% look much better already. The bottom line. It's one thing to hold something that might have run out 25% higher than your conservatively estimated intrinsic value, and another entirely if you're holding stocks with values so inflated they make no sense at all in a sane market. One danger with new investors is a tendency to trade often. When you own stock in a great business, which likely boasts a high return on equity, high return on assets, and high return on employed capital, the stock's intrinsic value is likely to grow over time. It's often a mistake to part with the company's stock just because it might have gotten a bit pricey from time to time. Look at the returns of two businesses, Coca-Cola and PepsiCo. Even though the stock price has been overvalued at times, an investor would have been filled with regret later after selling off their stake. Did above information help you? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.